Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host here for about the next 25 minutes here on Options Guide TV. Today's date is Wednesday, July 17th, 2024. We got a big down day in the market, and it is from not necessarily any specific economic news. It's the fact that both the Democrats and the Republicans are talking about adding some restrictions to chip makers and their ability to sell in China. And that was a big driver of the markets to the downside before the open. The only real bright news in the marketplace is the IWM. As a matter of fact, the IWM was up actually at one point in time when we still had the S&P 500 index and NASDAQ down. Right now, we see it down about just over 0.5% or $1. Well, in the Russell 2000 ETF, the IWM, we see that down about $1.40 on the day. We are showing weakness across the board, though, and a lot of it is people are talking about a rotation from some of the mega cap tech stocks into the small caps. So first time that's been talked about in quite some time. Russell is definitely lagging all the markets, even though over the last 4 sessions, the IWM is up about 11%. And that's going to be our theme today. That's the underlying that we're going to trade in. And once again, IWM is the ETF that tracks the Russell 2000 index. But before we get there, we are going to review our trade that we did in bank, and that is Bank of America. We did an earnings play. And on Monday's show, we looked at a long call spread centered around, we sold the most at the money option contract, very short term expiration, just hoping to get a little bit of bullish news in the financials. And in the financials overall, a lot of the major companies have announced earnings at this point in time. And in general, they've been fairly solid. I'd say solid to mixed. Wells Fargo got beat up a little bit worried about loan growth because they have a little bit more exposure in that area. JP Morgan had solid numbers, but the marketplace was kind of muted with their move. Bank of America was solid, very strong. Well, higher end. Once again, nobody has really had a strong move. Bank of America is one of them that probably had one of the larger moves to the upside. The expected move was right around 3.5%, and it moved closer to 4.5% after the earnings announcement. Earnings announcement was Tuesday before the open. We bought a just in the money long call and sold an at the money call option contract, mainly trying to deal with volatility. So we sold more time premium than we bought, and the market did move up. So the trade very quickly maxed out because we were doing a short-term expiration trade, and that is still the case. So let's run to the Tradier Pro software, and let's look at the options grid. We see where the market is at, 44.15. So here's where, when we did the trade, the market was right around 40 at that point in time. And my chains moved on me. I have no idea why that just happened. All right, 1 second. Let me get my bid and ask right where I'd like it to be. Okay, so the option contract that we bought was the 40 strike call, and that's now trading for 420. It's basically all in extrinsic value now, no more time value left. And then the one that we sold was the 42 strike. And as always, in order for a spread to max out, you need the extrinsic or the time value of the one that you sold, if you're correct on your forecast, to basically go to zero. You want it to all be intrinsic value. So here's the extrinsic value column, and you see this is based off of the midpoint. They're showing about 8 cents remaining in that option contract. We still got a few pennies actually showing up here on the 40 strike option contract, but more importantly, this is a 2-point wide spread. If I put that in, this is the way that we entered the trade. We'd have to flip the script to get out of it, but you're showing even the midpoint right at 2. You're not going to get 2. Even though the midpoint is showing you 2, never a midpoint fill is guaranteed. But the marketplace is not going to let you get out of that trade for no benefit to them. the width of the spread is 2 points and you see it trading for 2, 195 is much more likely. If you want to try working it, and because there are pennies, these option contracts do trade in pennies. You see this one 209 by 229, showing that it is that the option contracts will trade in pennies. So you can try 198. You can try 197. That's where the midpoint is at right now. I think 197 might be more feasible. And then I'd just give up the nickel and close out the trade. That simple. So you flip the script. We go in and we hit sell to close, but it's going to make me put in open. And then we put buy to close, and I got to put in open because this is just a test account. And we'd come in and say 197, and I'd leave it there for a little bit. And if that doesn't work, move it down a couple pennies and go to 195. Now, that obviously, the couple of pennies does not matter to me if I'm doing a 1-by-1 trade like that we usually talk about here on Options Guy TV. But if I'm doing a 50 lot or a 60 lot, yeah, that matters. So I'm going to try to work that trade a little bit harder on a much larger trade. All right. So that was short and sweet. It was very simple, very speculative trade around earnings in Bank of America, just hoping that we would get a pop to the upside. Expected move was well, we went more than the expected move. The expected move was only a couple of bucks, and I think we went like 350 on the open. But so almost instantly, this thing was trading at the maximum value of the short spread. And I like the way that we had it all set up and did the trade. I like this trade overall, the way that everything worked across the board. Still had to get right. You still don't know what's going to happen on earnings, if the marketplace is going to take it as a good or a bad. But overall, I liked the way the trade was set up, the dynamics, the risk reward, everything about this little Bank of America trade on a $44 stock. And as a matter of fact, on a $44 stock, I'm much more apt to do something like a long spread or just a short spread, as opposed to a butterfly on a more expensive underlying. We have Netflix announcing earnings on Thursday, and if we were doing an Options Guy TV, I would do a Netflix trade, but I'd be much more apt in Netflix being a higher price stock to go out and look at a butterfly or a skip strike butterfly, something, because you have so much premium, it's easy to widen out your wings and get it done for a fairly inexpensive price. And it changes the dynamics of the option pricing. Okay, that's simple. If you have any questions on that, by the way, please do put them in the chat box. If you are in the Tradier Hub, you can ask questions, but you just have to log in. Much the same with Google and YouTube. If you log into your account, you can actually ask questions if you're on the Tradier YouTube channel. And then we are streaming live on X. So my handle is @BrianOverby if you'd like to stream it there, or you can stream through the Tradier X profile. Okay, so any questions, please feel free to put them in the chat box. Now, it looks like we already have one. So let's put this one up before I go into the second trade today. Here's a question on the screen. Do you have set up rules somewhere? I was looking at my account on Tradier. Do you have set up rules somewhere? There is not necessarily set up rules. If you go to optionsplaybook.com, which is the book that I wrote, there are option guide tips that will highlight a few of the rules. On a long call spread, you're looking, the way that I set this trade up was specific to an earnings report. The fact that I would sell an at-the-money option contract and go a little bit deeper in the money is saying that I want to sell some of that vol premium. I want it to be a theta-based trade. So that's one of the things about rules, is that that rule might change after Bank of America announces earnings. So in this scenario with Bank of America, I might change everything else up if you still wanted to be bullish on Bank of America after their earnings report. So honestly, right now, if I wanted to continue my bullishness in Bank of America, I don't mind buying just to call option outright. I don't need to do the spread in this underlying. The implied volatility is a little bit high in the July expiration, but you see, if I go out to the August and go further out in time and want to be more bullish all the way out to September, you're seeing the implied volatility is now came down, is trading right about where the historical is at. 20% implied volatility on Bank of America does not scare me. The fact that it's trading at that range, and I'd be much more apt to do a long call spread, or I'm sorry, a long call, an outright call, as opposed to just doing a long call spread in Bank of America right now. So I hope that helps and answers the question. I'm looking at, so continue on a question. I'm looking at what direction the market is headed and where we close the trade or how long we stay in the trade. All right. So with Bank of America round earnings, it's basically, you're going to be in it the day after earnings. Almost always you're going to close very close to that earnings report. Now, if it's so far out of the money and there's nothing to really close it for, well, yeah, you just let it ride and play the hope game and hope that it comes back. But if I am, once again, you're looking at the market and I want to do an S&P 500 index trade, it totally depends on how long you're willing to be in the trade. So I'm going to change my outlook if it's based off of earnings and it's just based off of the general market. So with that said, I think I'm going to get into the trade right now. And that's probably the hardest thing. Now, inside the playbook, I address some of the management techniques, but knowing exactly how long you're going to stay in a trade, it really depends on the trade. And I don't have, and I'm sorry, I don't mean to skirt the answer, but for example, in our paper trading portfolio, we've been long NVIDIA. NVIDIA is now selling off a little bit. And I did say recently that I'm a little bit more nervous after the split that NVIDIA may come off a little bit before it goes up. But long term, if I'm looking at a 5-year outlook on NVIDIA, I'm very happy to own the stock or deep in the money option contracts like we have in our investment portfolio. But we adjusted our trade because of the risk in NVIDIA, took some of the money off the table, rolled our option contract, and kept our position on because of the nervousness of the marketplace. Now, NVIDIA is still doing really well. After it split, it's still up a little bit, but it is definitely down. It's down about 5.5% today, trading right around 120. Hasn't traded in that range in quite some time. Made a big run up to 136 and now is back in that range. Okay. So I hope that kind of helps, but I don't have there's no golden book of answers to say that every single trade I'm going to stay in it this long and this is the way that I'm going to approach it. So I do have a fun trade though. I have a trade that we haven't talked about much in the IWM. This is the one underlying, or the Russell 2000 index is the one index that's showing a little bit of strength right now. As a matter of fact, it was even up today when we have a very weak NASDAQ and S&P 500 index. So we saw a little bit of light from IWM. And the last 4 sessions, IWM is up about 11%. It's still lagging the big time stocks and the S&P 500 index and the NASDAQ. But I think it's at a precipice. We've very rarely do you get such a strong move to the upside. It's been years since you've had that strong of a move just in the small caps. There was a big short position in. I think it drove out a little bit of those shorts, or a lot of those shorts, I should say. We had a little bit an effect of a short squeeze in the IWM because you can short it because it is an ETF as opposed to an index. So you can actually sell the shares short. And there was a little bit of a short squeeze. It kind of made this pop. So now I think it's going to go somewhere, and it's going to go somewhere hard, either retrace itself a little bit because of the strong move, or it's going to move on the way up. I'm going to say I'm going to be on the bear side of things, and we're going to do a ratio spread. Now, this is an advanced spread. There is limited and known risk. Sometimes people will call it a pay later put. And once we look at the what if calculator, you will see why they call it a pay later put. So let's address the trade and get to it. So let's get rid of our trade that we're already done with in Bank of America. We would have been out probably on Tuesday after the earnings announcement. Now we're back to IWM. I'm going to go further out in time. I'm not going to use this expiration. I want time. Time is my friend in this trade. So we're going to go out to the August 16th or the August 2nd 16-day option contract. We have the most at the money option contract on the put side of things. This is the put side inside the Tradier Pro option grid. And we're seeing that's trading for about $4.35. Now, quite simply, I'm going to go up and look and see if I bought two of these, what option contract would I have to sell to actually pay for it? That simple, that straightforward. So we're going to sell one in the money option contract to help pay for two at the money option contracts. It's known as a back spread. That's what you would call it on the trading floor. But it's also known as a ratio spread. I like the name pay later put. So I actually have that highlighted inside the options playbook as a potential name. So if I go down to $5, that's not going to pay it. So I can't sell the 225, but I can do the 230. And that's how we're going to go about it. That means that we're looking for a 7-point move in either direction, 14 points overall. A 10-point move is about 4%. It's made an 11% move over the last 4 days. So the move is feasible. And there's not a lot of risk to start with on this trade. So we're going to go out 16 days. After 8 days, we might be out of it, depending on exactly where the market is at. But if the market just stays where it's at, I'm just going to get out of the position and move on. I'm going to have minimal risk on that. So here we go. Let's set it up so I can, I've already explained a lot of the concepts, but let me throw it in the what if calculator and it'll become a little bit clearer. All right, we're going to be selling the 230 strike, and we're going to buy two of the 223 strikes. That's 7 points wide. We're going to have an additional margin requirement because of that, but we can get this done for a net credit of 6 cents to the account, and that's my goal. If the market does go up, I don't want to lose anything. If I get the type of move that I'm looking for to the upside, I don't want to lose anything. But on the downside, I got the potential to make a home run, or at least I'm going to have substantial downside because the underlying market, in theory, could go all the way down to zero, that type of thing. And let's send it to the what if calculator, and everything will become clearer. All right, so here we are in the what if calculator. Here is our trade. It says a 10-cent net credit. We'll put it at 10 cents just to make it simple. If we can fill at a midpoint, never a guarantee. 10-cent net credit to the account. Market right here, last trade was at 223.58. That is the precipice of our peak to the downside, right on that range. Now, what's more important to me is the screen line. This shows you a lot of how this trade looks to begin with, and then how it looks at the end of the trade. So if you end up losing the maximum on this trade, which would be that $7 minus whatever the net credit was, you should receive the stupid award, because that means you rode it all the way to the expiration and the market was hanging right around the 223 strike, which is our strike price right here that we bought. And if we get a move in the short term, if we just get a small move to the upside, I'm going to highlight, look at over here on the profit and loss graph. It will show you where the green line is at as of today. So if we get a move down 223, let's say 4 points to the downside, which is a very viable move, you'd be up at 140 on the trade if that occurred today. If you can get an 8-point move, so let's go all the way down to 215, then you're up 340 on the trade. And at expiration, if you ride it all the way down, you have substantial upside potential all the way down, because stock, I say substantial because it can only go to zero, but basically unlimited upside potential on the downside. And then on the upside, to start with, if it goes up, you notice the green line is actually below at expiration. You need time to K. But if it goes in this direction, you're basically going to break even on the trade. Not too much worry, not too much concern. You would need it to get closer to the expiration date to be break even or close it out for zero if you could, or even would be the terminology that you would use when you send it to the trading floor. So this is very important to look at time. Right now, the profit and loss or the what if calculator is using this date and this time, 11/18. So let's go, let's move forward a few days. We're going to go all the way to next week, excuse me. And we'll do the 26th, and it'll be at 11/18 on the 26th, okay? Because that would be kind of our drop dead day when we really kind of want to get out of this trade if the market is just hanging right where it's at and it doesn't make a move. And if we do that and we look at it right now and the market stays right where it's at, which would be the worst case scenario, we're down 174 on this trade. So we're putting the trade on for a net credit. There is risk. Risk is from this strike down to here, the width of the spread, which is $7,700. But in our mind, if everything kind of stays the same based off of the calculator, we're going to get out if we're down around $200 on this trade. And if that does happen, then we need a stronger move. So the move matters. The quicker that we can get the move, the better it is. And so here's where the name pay later put comes from, is that you put it on for a net credit. You still have a margin requirement because you still have risk. And they say that if you are wrong, you have to pay later for your put. And the maximum that you could pay would be $7. We're looking at about $200 if the market does move it. If it takes all the way to the 26th in order, and it still hangs within this range, well, we're probably going to want to get out. We really need it to move outside of the wings. And we're hoping by that time it's going to happen. And then as I move forward, the expiration date on here is August 2nd. Let's go all the way out to the 1st. And now you see that this is pretty ugly within the strike. So I really don't want to hang around that long. And that's the way that I'm going to go and approach that trade. All right. So let's go back to the trading screen. And we'll highlight, this is where I'd take my screenshot. The market's at 223.07. We're looking to sell one of the August 2nd expiration 230 strike puts, at the same time buy two of that same expiration 223 strike puts, doing this for a net credit of 10 cents to the account. It's moved a little bit. We'll call it 10 cents. And we're going to have a $700 margin requirement. That's our max risk, but we're going to try to get out of that trade well before that max risk is possible to happen. And that's going to be it for this edition of Options Guide TV. Please follow me on Twitter. My handle is @BrianOverby. Please check out, and I will tweet this out probably tomorrow to get a status on this trade, but check out optionsplaybook.com. Look for backspread and backspread with puts, and you'll see a little bit more detail about this trade. Don't get to do it very often, but it's an alternative to a long straddle, as a matter of fact. It's got a little bit different risk profile, but you don't. The big thing about this backspread is that you do not care if the market goes up or down. You just need it to go up or go down in that scenario. Down is going to be the best case scenario, and we'll see if we get a little give back here in the IWM after the big run up this week. Thanks for stopping. We'll see you this Friday for the next edition of Options Guide TV. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.